Hello students, let us discuss important provisions of Insurance Act 1938. The object of the study are to discuss important provisions of the Insurance Act 1938 and Indian Contract Act 1872 relating to insurance contracts, insurer and insured. To discuss the process of registration of insurance companies, to enlighten the importance of insurance premium and policy documents, to explicate the process of assignment and nomination of insurance policies. The purpose of Insurance Act 1938 is to consolidate and amend law relating to the insurance. The Act is applicable to entire India and Union territories, all types of insurance business. The Insurance Act 1938 consists of 5 parts and 8 schedules. Part 1 deals with the definitions of various terms used and the provisions relating to the appointment of control of insurance. Other parts deal with insurers, insured, investigations, amalgamations and transfer of business, assignment of policies and nominations, and appointment of agents and their commission payments, winding up of procedures of insurance companies, administration and management of insurance funds, insurance associations and councils and authorities under the Act. Now let us know about insurer. Registration of the insurer. Eligibility. No insurer shall undertake the insurance business without having registration certificate issued by the Insurance Regulatory and Development Authority according to Section 3. A company formed and registered under the Companies Act 1956 having its sole objective to carry on life insurance business or general insurance business or reinsurance business is eligible for registration. According to Section 2C1, an Indian company can undertake the insurance business jointly with a foreign company or group of investors wherein the foreign investment should not be more than 49% of the equity and does not include any foreign bank or a company. An applicant is required to file a separate requisition for registration of each class of insurance business. Name of the insurer. Name of the insurance company should not be similar or identical or deceptively resembles the name which is already in existence or closed, with or without any intention to deceive the customers. Capital requirement. The minimum capital required to start either life or general insurance business is rupees 100 crores and reinsurance business is rupees 200 crores. It is in addition to the deposits to be made under Section 7 of the Act and preliminary expenses incurred. The capital should be in the form of ordinary equity shares having a uniform face value. The insurer shall not issue preference shares or shares carrying different face values. The individual shareholders other than the promoter or investor company or banking company can hold shares equal to 1% of the total share capital. The investor company can hold the shares of 5% to the total share capital. The banking company is permitted to hold 2% more than the investor company, that is 7% of the share capital with the permission of the central government. The company should maintain the register of the members and shares held each one of them. Section 6C permits the conversion of a company limited by shares into a company limited by guarantee. Deposits. The insurance company making application should deposit a sum equivalent to 1% of his total gross premium underwritten in India in any financial year and not exceeding rupees 10 crores. In case of general insurance, a sum equivalent to 3% of his total gross premium underwritten in India in any financial year not exceeding rupees 10 crore, and in case of reinsurance business, a sum of rupees 20 crores. Requisition and application. Every bona fide and eligible company interested to undertake the insurance business should submit an application form in IRDA R1 for each class of business, such as life insurance business and general insurance business, along with the following documents: certified copy of memorandum and articles of association of the company incorporated, statement showing the name, address, occupation of principal officers, directors of the company, a statement containing the information regarding the class of insurance business proposed to be undertaken, and a statement of capital structure and sources of the capital. The IRDA, if satisfied, may approve the requisition and communicate to that effect. If it is not satisfied, it may reject the application along with the reasons or seek further information if required. The applicant, after receiving the communication of rejection, within a period of 30 days can apply to the authority for reconsideration. If the requisition is rejected again, he has to apply again only after 2 years. The company, after receiving the acceptance of requisition, should submit an application in IRDA R2 form for grant of certificate of registration of the company along with the additional documents. Statement of shares with the distinctive numbers issued to the shareholders and promoter directors. A documentary evidence to show the availability of the corpus fund of rupees 100 crores in case of life insurance or general insurance business, or rupees 200 crores in case of reinsurance business. Documentary proof of paying the deposits and fees as required by Section 7 of the Act, and expenses incurred towards the preliminary expenses of the company. Original receipt of payment of the fee should be enclosed. Information by way of standard forms, working of schemes, formats of proposals and policy along with the warranties and conditions of the policies or exclusion clauses. A certified copy of the prospectus published. An affidavit by the promoters regarding the disclosure of information to be true, and a certificate from the practicing chartered accountant or company secretary stating that the information mentioned in the application and the accounts, the issue of shares and equity capital and promoters are correct. The authority, after satisfying about the equity capital, promoters' track record, experience in the business, legal, administrative and professional expertise of the promoters and authorities, appointed, availability of infrastructure to the market, the insurance business and the types of insurance products and schemes, rates of premiums and other facilities may issue a certificate of registration in form IRDA R3. If it is not satisfied, it may reject the application. After receiving the communication of rejection, the applicant may apply for the registration after 2 years from the date of rejection with a changed composition of directors and other infrastructure facilities for want of which the application was rejected. A duplicate certificate of registration on loss or mutilation of the original certificate of registration may be given on filing application form in IRDA R4. Commencement of business. The applicant, after receiving the certificate of registration, must commence insurance business within 12 months from the date of certificate of registration. The authority, on application, may grant the extension of the time for further period of 12 months, but not beyond 24 months from the original date of certificate of registration. Renewal of certificate of registration. The tenure of registration of insurance business is 1 year only. The insurance company has to apply for renewal of license in form IRDA R5 by paying the requisite fee of rupees 50,000 in the month of December every year, and along with 1% of total gross premium written directly by the insurers India during the last financial year. On receipt of the application of renewal, the authority will issue a certificate of renewal of registration. Cancellation of the registration certificate. The authority may suspend or cancel the certificate of registration on the following grounds as specified in subsection 4 of the section 3 of the Insurance Act 1938 and amended by the IRD Act to 1999. If the insurer fails to maintain the deposits as required, or adjudged as insolvent, or transfer the business of any class or the business to any other insurer under the amalgamation and merger process, on the grounds that the business of insurance is detrimental to the public interest or policyholders' interest, if the insurer fails to comply with or defaults with the provisions under this Act, if the insurer fails to pay the claim within 3 months from the date of final judgment in regular course of law, or diversifies the business and undertakes any other business other than the insurance business, if the insurer indulges in malpractices and misappropriation of the funds received in the insurance business, if the insurer fails to submit the periodical reports and statements as required, it fails to invest the funds as required by the Act. Rights and duties of the insurer. Duties of the insurer. The insurer has to pay the claim on happening of the event or risk within a reasonable time and not to indulge in delaying tactics. Insurer has to accept the premium if paid within the usual course of insurance business. It should supply the stationery like the proposal form, claim form, and other required information to the insured or his authorized agent. The insurer is under an obligation to issue the insurance policy. The terms of the policy should be informed to the insured. Liabilities. Insurer is liable for frauds committed by his agent. The insurer is under the obligation to comply with the provisions of the Act, such as undertaking the business of rural and social sector, maintaining the books of records, registers, accounts, and submission of reports to concerned authorities on time, and also provide other information as required or as and when asked by the authorities under the law. Rights of insurer. The insurer gets rights under the terms of insurance policies or under the law of contract and include a right to demand and charge the premium to cover the risk. The insurer has the right of subrogation and contribution. The insurer is having a right to take possession of the salvage and sell and receive money. The insurer is having the right to sanction loans against the policies to an extent of 90% to 95% of the surrender value of the policy. It has the right for reinsurance wherever necessary. Insurance premium. No insurer shall assume any risk in India in respect of any insurance business unless and until the premium payable is received by him or guaranteed to be paid by such person in such manner, such time as may be prescribed under section 64 VB 1 of the Insurance Act 1938. In other words, unless the premium is paid or guaranteed for payment, the insurance contract will not come into existence and risk will not be covered. Lawrence J. defines the premium as price paid adequate to the risk. The risk is the circumstances which may lead to the damage of the asset or may cause loss to the life. It is subject matter of the insurance contract. The amount of premium is directly linked with the risk involved in the contract. The higher the risk in a contract, the higher is the rate of premium. The additional premium is paid to the insurer for the coverage of additional risks. For example, additional insurance premium is paid on the policies of life to cover the accident risk. In an insurance contract, the premium and promise to compensate the insured on suffering of loss by the insured are the considerations. Let us know about payment of premium. Payment of premium is necessary to make the insurance contract valid. The premium can be paid either in cash or by checks. Section 64 VB2 of the Insurance Act 1938. The premium may be paid either by the insured or his authorized agent. If the premium is collected by the insurance agent, he has to deposit the premium within 24 hours of the collection, excluding the banking and postal holidays. The premium has to be paid before the expiry of the policy, so the premium received under a contract entered by the insurer by operation of fraud becomes void and the premium paid will be forfeited. Whereas the premium paid under the insurance contract becomes unlawful or illegal before commencement of the policy and assuming the risk, the contract is invalid and the premium will be refunded. Let us know about policy document. The insurance policy is a standard format of contract and evidence of the terms and conditions as agreed by the parties. It contains three important parts: the heading or preamble, body of the policy and back of the policy. The preamble of the policy contains the names and address of the insurer and insured, amount of the insurance contract and insurance premium payable and tenure of the contract. The body contains clauses governing the contractual relationship such as risks covered, terms of the insurance, the dates of the premium payable. The back of the policy is where the special conditions and terms are incorporated. This part also provides for assignments and other endorsement. The policy document require the stamping as per the Indian Stamp Act, and the policy which is not stamped is not accepted as evidence in the court of law. The cover note is a temporary form of policy which will become inoperative from the date of issue of the policy. This cover note contains the particulars such as names of the parties, risk covered, insurance amount, premium amount paid, duration of the insurance contract and other special conditions if any. The cover note is issued in the general insurance business only. The proposal form submitted by the insured becomes a part of the insurance policy document. The life insurance policy provides an option to the insured to refuse the policy within 15 days from the date of receipt of the policy on the ground of variations in terms of the policy agreed upon. The facts and information provided in life insurance policy shall not be questioned or disputed by an insurer after the expiry of 2 years from the date of its issue as inaccurate or false. Section 45 of the Insurance Act 1938. The only ground to dispute the policy is the fraud perpetrated by the policy purchaser, particularly relating to the material facts of the policy. The life insurance policies generally contain the following important information: the name of the plan governing the policy, along with the terms of participation in profits such as cash bonus, deferred bonus, simple or compound revisionary bonus, and riders attached to the main policy. The dates of commencement, maturity, and benefits payable on the insurance policy. The premium payable, periodicity of payment, the due date of the last installment of premium, and also the provisions of guaranteed surrender value. The age of the insured and whether the same has been admitted or not. The policy requirements for conversion of the policy into paid up policy, surrender of policies, non-forfeiture, and renewal of lapsed policies. The provisions for nomination, assignment, and loans are security of the policy, if any. The existence of an insurance ombudsman, other grievance redressal mechanism for resolution of the disputes like claims review committee with zonal, regional, head office, central office. The general insurance policy document generally contains the following information: the name and address of the insured and of any bank or any other person having financial interest in the subject matter of insurance, full description of the property or the interest insured, and the location or locations of the property or the interest insured, the sum of the insurance excluded or included perils and period of insurance, premium payable, terms and conditions of the policy along with the claim procedure, the existence of an ombudsman and other forms of resolution of disputes methods available to the parties. Let us understand the assignment of policies. Insurance policy is considered as a property and transferred by way of assignment. The section 38 of the Act 1938 defines the procedure for effecting the assignment of the policy. The transferor or assigner can transfer or assign the insurance policy either for consideration or without consideration, or for securing a debt or part of the debt by giving a notice in writing to the insurer. On receipt of the notice, the insurer records the date of the notice and date of the receipt notice, the beneficiary particulars, and quantum of benefit as an endorsement on this policy. The endorsement should be made in writing and attested by 2 witnesses. The endorsement may be on the policy itself or by a separate instrument. If the endorsement is by separate instrument, it requires stamping. Delivery of the policy to the transferee is not a compulsion under the law of assignments. The beneficiary gets a right to sue for the payment of stated amount on happening or not happening of the event. The conditional transfer can be made by the transferor. The beneficiary is subject to the liabilities and equities arising out of the transfer or assignment. Nomination. Section 39 of Insurance Act 1938 deals with the nomination. The nomination is the process by which the policyholder transfers the right to receive the benefits under the policy to another party on happening of the event or otherwise as stated in the nomination. The salient features of the nomination as stated by the Act are as follows. The nomination can be given either at the time of entering into the contract of insurance or at any time after the insurance contract is concluded, but before the date of maturity of the policy. The policyholder can nominate one or more persons as his nominees and can change the nomination at any time before the maturity of the policy. The nomination made can be cancelled at any moment. The nomination should be made in writing addressed to the insurer. The insurer, after receiving the notice of nomination, records it on the policy. The creation of the assignment or transfer of the policies cancels the nomination. The nominee holds the claim amount of policy as a trustee, but legal heirs will have the priority over the nomination. If the policyholder nominates his wife and children as the nominees of the policies, the asset becomes the property of the wife and children under the provisions of Married Women's Property Act, and the policyholder or other successor have no rights other than as a trustee of the estate. Summary. The Insurance Act 1938, enacted prior to the independence to meet the needs of the objectives of the country, is amended many a times, including in the year 2015. It is a central act and applicable to entire country and all types of insurance business: life insurance, general insurance, marine insurance, and vehicle insurance. The act, the rules made thereunder, the regulations and notifications made by the IRDA governs the insurance industry. More particularly, the insurers, policyholders, the insurance intermediaries, claim payments, funds management, and winding up the insurance companies. Now, this gives a holistic view of insurance company registration, insurer, insured, the salient features of the insurance policy, how the insurance policies are transferred or assigned to other policies. Thank you.